ultimately, I've said it before, I'll say it again, I'm not talking my book. I'm not trying to get you to run to the phone and make a phone call, but I'm dead serious. I really do believe that this market, before it's all said and done, will be looked at two ways by the people from the outside. Geez, prices got so high, I'm out. And the people on the inside, I want more, but it's so hard to get it. And the prices, the premiums are high and the delays are high, and used to be so easy to get it. I took that for granted, and now it's next to impossible. I believe that'll happen.
Andy's observation is simple but profound. The conversation about precious metals is no longer confined to the usual corners of the market. Over the last several months, we have watched portfolio architects, chief investment officers, and research heads, the very people who set allocation policy for large institutions, begin publicly to question the 60-40 orthodoxy and to recommend materially larger weightings to gold. That shift is important because it changes the character of demand. This is not speculative chatter from the fringe. It is reallocation from the center of capital, and when the center moves, the periphery feels it immediately. The reason they are looking is straightforward and unromantic. Fiat currencies are being eroded by inflation and policy, and bonds now deliver returns that, in real, after-tax terms, are often negative or marginal at best. When the expected real return on fixed income is weak and price stability is in doubt, institutional stewards start asking the hard questions about how to preserve purchasing power for clients. Gold, and, by extension, silver, addresses a preservation problem in a way that paper assets do not, and that practical reality is forcing serious portfolio discussions at the highest levels. There are additional tailwinds that make this reallocation more than rhetorical. Momentum has been building in the pricing curves and technicals, ETF flows have been meaningful, and geopolitical and monetary frictions are nudging behavior toward tangible stores of value. In today's video, Andy takes us deeper, outlining the institutional signals he's watching, the technical evidence that supports continued momentum, and the very real pressures in the retail bullion pipeline. If you find value in these insights, make sure to like this video, subscribe for more analysis, and drop a comment with your thoughts on whether you believe gold and silver are finally stepping back into the monetary spotlight.
I'm looking at the futures right now. That's why I was glancing at my phone, and it's shocking. You have silver futures at $47.30, up fairly significantly today, and gold futures up $50 to $38.58. So we're seeing a continual movement in the price of metals that is exhibiting strength that I'm really not used to. Then again, I mean, it's moving at a clip that just seems to be defying gravity, and now I don't expect it to be that way continually, but I think what it is showing is that we're seeing a lot of big money now start to move into the space. You can see that through the massive numbers in the ETF space, where we're seeing huge amount of volume go into the ETFs. This is institutional money, if I had to guess, waking up to the reality, talking to their clients about purchasing metals. But it goes beyond that. You know, we talked about the chief investment officer of Morgan Stanley, shifting his allocation model to 60-20-20, where it was 60% stocks, 20% bonds, 20% gold, breaking free from the 60-40 model that has been out there forever. But now it's going deeper than that. And now you see Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills, those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50%. Just goes to show. You got a guy named Chris Wood, I think is his name, Chris Wood, the global head of equity strategy at Jefferies. Jefferies Beige was the name of it before, or Jefferies Beige. It used to be Prudential Beige, and Jefferies bought them. Prudential is who nominated Miles Franklin to be an authorized reseller of U.S. Mint product many years ago. So Jeffries took over for Beige and then got out of the gold business. Evidently, they didn't believe it was the path for them to take. Yet now their head of equity strategy is talking about gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gundlach, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock, talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split. And I guess when you see players at this level start to talk about it, certainly we should take notice. I also found it interesting, Michael Oliver talking about meddling. Michael's a frequent visitor to your show, and he was talking about the lid coming all the way off is what the MSA is what they're predicting, his moving averages or his momentum averages, momentum indicator. And he says that over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200. And he says that they expect such. He also talks about not being fooled by any sharp drop that we see. He looks back to the way the markets reacted before previous bull markets, and he says they fully expect to see a corrective jolt at some point, but it's part of the current upward progress, and so not to be fooled by it. I found that to be interesting. And he talked also about gold, which has broken through a 12-year-old gradual uptrend channel. Again, technical analysis, but basically saying that he thinks that this month is poised to produce a new high peak monthly close on annual momentum. There's only a few days left in the month. Again, these are all very, very, very bullish things for the price of gold. And I just think that people in this country have yet to recognize that gold is rising, and rising against all of the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system. Because in my mind, as much trouble as China is having, their yuan gets saved by gold. And the dollar, without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia, you'll have the vaults in St. Petersburg, of course in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system, where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, he is they call him, that just came to me, call him the bond king. And he is saying that it's time to move away from traditional 60-40 split. This is a guy who in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out, at least at 4% per year, but actually it's probably a lot more than that. They talk about a money supply that has increased by as much as 7% per year. You see M2 again racing higher right now. So as we see money creation running at such a level, your $10,000 right now after an 11% drop is worth $8,900. And so if you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this, it's a losing game. It's no wonder that they don't say this.
When the people who manage large pools of capital begin to change the framing of portfolio construction, suggesting meaningful allocations to gold, the market notices because those allocations translate into concentrated, persistent demand. Technical breakouts and momentum indicators add conviction to that demand, but it is the shift in the nature of buyers that matters most. Long-dated, patient, institutionally financed appetite behaves very differently from retail reflex buying. That institutional story is the necessary background for the point Andy raises next about the physical market. Once large pockets of money move from a paper benchmark into physical or physically convertible instruments, the plumbing of the industry comes under strain. Shipping, insurance, dealer inventory economics, and primary mint production are not elastic on short notice. In the next clip, Andy details how those mechanics are already constricting supply and widening premiums, a dynamic that can turn a rising price trend into a self-reinforcing scramble for physical metal.
Increase as well. Can you touch on the retail bullion phenomenon that you're seeing both in terms of demand, supply, physical availability, and premiums?
Yeah, demand is really strong right now. Supply, which has been really good for a while, is getting very tough. And why is that? It's because supply was so good that the dealers didn't re-up. And with the rising prices, the cost of carrying this stuff is very expensive. The cost of shipping it has become very expensive. The cost of insurance to ship it has become very expensive. Just the cost of holding a large inventory has become very expensive. You better have millions and millions and millions of dollars in order to run an inventory, or you have nothing. And so, I look at our inventory, which I'm not happy with it right now. It's gotten so low so fast. And this is one of the things I was concerned about. And I say this on your show all the time. Just like that, it changes. And the market does change. And it wasn't just the companies like ours that feel this. It goes all the way up to the primary distributors who, again, they were choking on product too for a while. Like you said, that was slow at the beginning of the year. And just like that, it's not. And there's lag time between getting new product in from around the globe. The U.S. Mint, who really is the model of inefficiency, can never keep up adequately. And this is with now just a glimmer of new demand, and maybe it's coming from higher levels because you're getting this advice coming from Morgan Stanley and Jefferies and Bank of America. These people are talking, the CIOs or Michael Hartnett's of the world aren't talking to Jane and Joe Sixpack. They're talking to their institutional clients, their big money clients who are paying huge money for Michael Hartnett's writings. And same thing with the chief investment officer of Morgan Stanley. That's not stuff for the public. You pay for that stuff. This is the stuff that's given to their big clients. These are the people who are making moves before the public. The little man is still sitting in the Mag 7. The little man is still sitting in traditional assets, really doing or set up to do as well if things continue as the insiders are selling and the public is all in. It's something that concerns me, honestly. And you've had me on your show here now talking about this really since 2024, where it's been slower than we would expect in an environment that shouldn't really, if you look at the facts, it shouldn't have been slow. But now people are waking up, not just the diehards that you and I have spoken to forever, the mainstream, just a little sliver of it, and probably the sophisticated side, the well-informed side, more so than the masses. But when you get, Dunlock and Bank of America and Morgan Stanley and Jefferies all saying the same thing, That's going to change. And now all of a sudden, supply is becoming tougher to come by. Premiums are rising, and it doesn't take a whole lot of demand to wipe out inventories that have not really been aggressively added to. So we are in the process of doing that right now, but there is a lag time. And I would say to you, you haven't seen anything yet in terms of demand. If these guys are right and they're telling, putting the seed out there that hey, this is about to explode, just a small uptick from the public will decimate availability in this industry overnight. And I don't say that lightly. I mean it sincerely. There's so much money out there, not to mention M2 spiking right now. Money creation and just money in circulation that's been sitting on the sidelines in places like money markets and in treasuries, which are now being, maybe you shouldn't own so many, reevaluated by the people who sell them. I think that ultimately, I've said it before, I'll say it again, I'm not talking my book. I'm not trying to get you to run to the phone and make a phone call, but I'm dead serious. I really do believe that this market, before it's all said and done, will be looked at two ways by the people from the outside. Geez, prices got so high, I'm out. And the people on the inside, I want more, but it's so hard to get it. And the premiums are high and the delays are high, and used to be so easy to get it. I took that for granted, and now it's next to impossible. I believe that'll happen. I do. Because on our interview with Rick again this morning, he talked about the 0.5% allocation. What if it's 5%? Well, these guys are saying 20 and 25%. If it went to 25% or even 20%, well, that's a 40-fold increase. Just like that. Do you think that this industry can survive a 40-fold increase? Not a chance in Hades. And it would be lucky to survive 24 hours with a shift to that magnitude. And if they're saying 20 or 25, what do they really mean?
The most practical takeaway from Andy's assessment is this. Price discovery in precious metals today is a two-front process: paper markets, futures, ETFs, derivatives, and physical markets, bullion, coins, allocated bars. Institutional flows can push the paper price rapidly, but the physical market determines how that price translates into real-world access. When premiums and delivery lead times widen, the marginal buyer in the retail market is forced to make decisions that then cascade back into price behavior. People pay the premium, inventories drop, and dealers raise prices to manage balance sheet risk. That feedback loop can make physical shortages appear far faster than headline prices alone would suggest. Quantitatively, even modest increases in allocation at the institutional level imply disproportionate demand for metal. To use a simple illustration, moving a portfolio allocation from a fraction of a percent to a few percent is an order of magnitude change in demand. Pushing allocations into the tens of percent, even if only considered hypothetically by some strategists, would represent multiples in the dozens of existing institutional demand. That mismatch between the size of potential reallocation and the current physical inventory base is the structural vulnerability Andy is warning about. It is not hyperbole to say the physical market would struggle to keep pace with a material shift in institutional posture. That structural stress also exposes practical risks and opportunities for investors. Risk, premiums, transactional friction, and the potential for sharp, disorderly price moves in the short term as delivery frictions are resolved. Opportunity. Owning metal and/or backed instruments ahead of a broad institutional reallocation can capture asymmetric upside if the technical and macro signals sustain. Operationally, investors should distinguish between paper exposure, ETFs, futures, mined equities, and allocated physical exposure, insured, audited storage. Each has different liquidity, counterparty, tax, and custody implications. And those differences matter more when a market moves from being purely price-driven to supply-constrained. On silver specifically, the case is more nuanced. Industrial demand growth, limited new mine supply, and concentrated above-ground inventories mean silver can be the more volatile beneficiary in a metals bull market. That volatility amplifies both upside and risk, and for that reason, position sizing becomes paramount. If you expect large institutional flows into gold to spill over into silver, the likely path is sharp directional moves punctuated by steep corrections. If this analysis helped clarify the most important trends in the precious metals and resource sector, please subscribe for more deep dives like this and leave one question in the comments. What allocation, if any, are you comfortable holding in physical precious metals and why? I'll read the top comments and pin the most thoughtful responses. Thanks for watching. Stay analytical, protect liquidity, and we'll see you in the next deep dive.